Welcome to Chapter 1, Introduction to Insurance, Introduction to Life Insurance, and Introduction to Health Insurance. So in my typical live class, I have everybody in the room at once. I've got some people who are life insurance people, some people who are health insurance people, but almost everybody in the room is doing both life and health. So the way the book is structured is flipping the page. The first section, Section 1, Insurance Basics, Chapters 1 through 7. 1 through 7 are life and health chapters. Everybody will do these. Then Section 2 is life only, and Section 3 is health only. So if you're doing the life only, you'll do the first 7 chapters plus 8 through 22. If you're doing health only, you do the first 7 chapters plus 22 through 33. Because I don't want you to read any more of this than you have to, of course, but for 95% of us, you'll be doing the whole course. So to get us started in this introductory chapter, who are the people we're dealing with here? So on the bottom of the second page, who are the key players in an insurance transaction? Well, on line 23, the big rich insurance company is the insurer. So the insurer is the big insurance company located in New York or Hartford, Connecticut or Indianapolis or wherever. It's not the little office in your hometown. It's the big company headquarters. That's the insurer. Then the person covered by the policy is the insured, or I think of Ed, the little guy, as being insured. That is, Ed is the insured. So the insured buys the coverage from the insurer, but will end up going through you. Top of the next page, a very important term for us is the policy owner. And somebody has to own the policy. This somebody is usually, but not always, the person covered by the policy. So if I buy a life insurance or health insurance policy on me, I am the insured and I am the owner. But it's possible that my wife Nancy could buy the policy on me, in which case she's the owner, but I'm still the insured individual. So we have to figure out who owns this policy, because the owner has the opportunity to change it. If I'm a mere insured but not an owner, in which case Nancy owns the policy, she calls the shots and controls the policy. Then we need to be aware that, of course, there's a beneficiary, somebody who's paid when the claim is submitted. That could be me, could be Nancy, could be the high school that I attended, could be the university, could be charity, kids, anyone could be the beneficiary. And that person can come and go. We can change beneficiaries frequently. Then you are an important person here. So you are, well, you used to be called the agent. An agent is a holdover concept from the good old days. When you were an agent, that created the appearance, said the lawyers, that you had authority to change things in the policy. And so in the good old days when you were called an agent, anything you said could be held against the insurance company because it designated you as their agent, and that meant you had authority to change coverages, make promises, etc. Well, enough insurance companies got sued over things said by their agents that they changed the name from agent almost universally across the country to producer, which is a namby-pamby bland term which doesn't imply that you have any authority to make promises on behalf of your insurance company. So I might refer to you as the agent. Most of the time I will refer to you as the producer. The exam will go both ways, and then when we get to the state rules, we'll find the states are usually inconsistent. Some places in the state rules, they call you a producer. Other places, they'll call you an agent. But we're gradually in the process of converting from the old name agent to the new name producer, to save the insurance company some money when it gets sued for your mistakes. Because if you make a mistake and you're an agent, they're liable. If you're just this neutral producer, then maybe they're not liable. So in any case, we'll call you an agent that is a producer, and as an agent or producer, you represent the insurance company. Then in a few states, they have licensed people as brokers. Now I have to watch out for the word broker because it gets used 10 different ways in each state, it seems. But technically, a broker is somebody licensed to sell insurance, but they represent the little guy, the insured. They're on the insured side, not on the company side. So my home state doesn't allow the licensing of brokers. Everybody's a producer. Your state may license both brokers and producers, or only brokers or only producers, whatever. So be aware though that the broker represents the little guy, the insured. The producer represents the company, the insurance company. So moving on with some more introductory terms, insurance is all about risk on page 4. Risk is the key to everything. If we could pin down exactly the amount of the risk, then we would know what kind of a premium we had to charge, and we would know whether we wanted to insure a particular person. So insurance is all about risk. So if insurance is all about risk, shouldn't that be a test question? Shouldn't they ask you to define risk? Sure. So all of the dictionaries in line 3 define risk as either the chance of loss or the uncertainty of loss. And those are the same thing. So risk is chance of loss, risk is uncertainty of loss. Is risk certainty of loss? No, not on our test. Risk is chance of loss or uncertainty of loss. And what an insurance policy is doing is having the insurance company take over some or all of that risk. Now, I like the idea of an insurance company taking on risk on my behalf. So what I would like to do is go to Las Vegas, gamble in the casino, and have your insurance company take the risk. And you say, wait, time out, we won't do that because that in line 17 is a speculative risk. Gambling is an example of speculative risk. There's a chance of loss in hope of realizing a gain. And insurance companies won't cover speculative risk where there's a downside and an upside. So line 22, insurance covers pure risk but not speculative risk. Whoa, what's pure risk? Where did that come from? Well, back up in line 12, pure risk is the chance of experiencing a loss without any gain. So car wrecks, sports injuries, dying, getting sick are all pure risks. So line 16, insurance companies are willing to insure pure risk but won't insure speculative risk. I think our test writers will simply ask, what is speculative risk? Well, the chance of a gain or a loss. What's pure risk? Chance of a loss only. And which is covered by insurance? Insurance covers pure risk where you could suffer a loss but won't insure speculative loss, speculative risk where there's a chance of a gain. So everybody's concerned about risk. Insurance companies are concerned about risk, and your clients, the insureds, are also concerned about risk, and they want to take care of risk in the cheapest way possible, assuming they have any money. If they have no money, then they're not concerned about taking care of risk other than perhaps being careful. But there are several risk management techniques. Now, one risk management technique I use is risk avoidance. I don't go to the New Year's Eve party, for example. I stay home and sound asleep by 10:30 at night. Boring guy. So I avoid risk. Now, something else I could do is go to the New Year's Eve party, but not drink, not cause any trouble, and take my buddies, the bouncers, along with me, a couple of football players. Well, that would be an example of risk reduction. So is risk avoidance a risk management technique? Yes. Is risk reduction a risk management technique? Yes. Or I could shift the risk. Now, if I own the house where the party takes place on New Year's, what I would want, and this is the lawyer in me coming out, I would want everybody that comes to my New Year's Eve party to sign a waiver of liability, that is a hold harmless provision, saying that if they get hurt at my New Year's Eve party, they won't sue me. Well, that's shifting the risk back on somebody else. But for most of us, the typical risk management technique is buying insurance. Now, if we have any money, or I should say any spare money, we'll buy insurance. So is insurance a risk management technique? Sure. But so is self-insuring, that is retaining the risk, is also a risk management technique. Most cities, most counties, all of the state governments, the federal government, and big businesses like Walmart typically don't buy insurance. They self-insure. And so they'll plan ahead and figure out how many claims are they going to have for various things during the year, set the money aside, and use that pool to pay the claims. So we simply save the expense of insurance premiums, set up a fund to pay claims that an insurance company would have paid. So a whole lot of people say they're self-insuring when they just don't have any money, but self-insuring from our point of view is looking at this professionally and setting aside the money to buy insurance. So those are various risk management techniques. Our standard test question is to simply list one of those along with some other garbage terms and say which of these is a risk management technique, or to say insurance is, and then the answer is a risk management technique. Easy stuff because we're at the easy introductory level of the course. Then if we're going to manage risk by buying insurance, there's some key terms we need to look at. First of all, what is insurance? Well, you could have 1 million people come up with 1 million different definitions of insurance, but on our exam, we're going to throw one of these 4 at you. So here we go. Line 22, insurance is a contract. Now, I tend to say it's a policy, but a policy is a contract whereby an insurer agrees to protect an insured against injury, damage, or liability arising from some future event. Getting sick, for example, sounds to me like insurance. Or, here's my favorite, insurance is the transfer of risk. Now, it's a little incomplete, shortcut definition, but it's our favorite for our test writers. Insurance is the transfer of risk. So we could say an insurance policy transfers some portion, it could be all of the policyholder's risk, to the insurance company. And I say some part because with health insurance there's often a deductible, so I haven't transferred all of the risk to the insurance company. Life insurance, there is no deductible, so I've transferred all the risk to the insurance company. Another definition we could use is insurance is a social device through which individuals, by paying a premium, transfer a defined but limited portion of their risk to the insurance company. Now, what's this limited portion? Well, every policy has a maximum amount it will pay, the limit of liability, so I am transferring a defined and limited portion of the risk to an insurance company. And insurance is a mechanism for sharing risk among a large number of policyholders. Well, what you and I call sharing the risk among a large number of policyholders is the same thing as saying we're spreading the risk among a large number of policyholders. So is a function of insurance to share the risk? Yes. Is a function of insurance to spread the risk? You bet. So now that we know what insurance is and have a basic understanding of the concept of insurance, let me pause there, grab a coffee break, and we'll come back and finish up this easy introductory chapter.